We are live also on YouTube as well at Smart24 TV. Now we have our guest today who is Mr. Tony Mugisha from A10 Capital, a financial advisor with a vast experience globally. He has worked with companies like FedEx, Aramex, and recently Vivo Energy. And he has been here before on the show. And today we are here mostly to talk about life insurance and why it's important. We would like to know why this thing called life insurance is not actually as popular as well amongst Ugandans, and why it should actually become, because as he always puts it, it's the first thing before any other investment. Mr. Tony, thank you very much for coming.
Thank you so much, Anthony, for inviting me back again. It's a pleasure to be at Smart24. And thank you so much for our viewers for tuning in. And like Anthony has said, I'm hoping that today I'll be in position to give clarity on what life insurance is and why we should take it serious.
Yeah. Let's get started right there. What is life insurance to a lay person?
Okay, I think the best way to put it to the layman person is, you see, Anthony, if you had all the time, you would recreate pretty much everything. But there's no amount of time can be given to you to recreate life. So what that then ideally means that the most important asset that you can have is your life, because it is you who creates everything. So the question is, what value have you put to that life? Maybe 95% of the people put 0 to that. So in a nutshell, life insurance is the value. Life insurance is not about you. It's about the people you care for most. So in your absence, what asset is there that's going to be in position to give value to the people that you really care for?
Now let's look at are there classes of like life insurance that this is for maybe children, this is for health, this is for family? What are some of those things that life insurance looks at in particular?
Okay, first and foremost, the penetration of life insurance in this country is at 1%, which I believe as a country we need to do more. And I mean, that's why we are here. And that's why when you give me an opportunity like this to share about life insurance, I'm quick to do that, because I hope that I've given a different perspective, or I've given people something to think about in terms of life insurance. Back to your question, all insurance companies sell 4 products. You see, in insurance, there are two types of insurance. There is general insurance, that general insurance which includes fire, homes, comprehensive, among others. That's under general insurance. So literally in general insurance, you insure for a specific period, and usually it's about 12 months, whereby if a risk happens between that time you've insured, the insurance company will pay back depending on the terms that were agreed upon. That's general insurance. The one that we're talking about today is life insurance. They both are different. Even the licensing is different. You need a different licensing for general insurance, and you also need a different licensing for life insurance. Now, the one for life insurance, and to be very precise, because that's where I'm going to focus, there are 3 types of life insurance. You see, I've told you that previously, I think on your show, I told you that all insurance companies sell 4 products. That's to say, you die, they pay. You fall sick, they pay. Falling sick, that's critical illness, not any kind of sickness. You retire, they pay. And you die, they pay. Now that we know that all life insurance companies pretty much sell 4 products, by that I mean that a company can have 12 or 15 products, but they are pretty much into that category. Now, which then brings me to the topic. It's never about the product. It's about who advises you on what plans you need to take out and how they perfectly fit into your financial plan. A good example would be that in terms of hierarchy, I need to ask, do I go for an income protection plan first, or I go for an education plan first? Now, when you go deep down on those products, there's types of insurance also. There is term insurance, there is whole life, and then there is endowment plans. Okay, they are all types of life insurance. They all pretty much work differently. So again, that's what I told you, that it is who advises you on what plan to take out, not the product. Yes, different insurance companies will have a variance here and there.
Yes.
And of course, who the insurance company is and how long they've been around. Of course, those are really very key to note. And but the most important thing is who advises you and on what plan they recommend you to take out and how it fits in your financial plan.
Yes. Now we've talked about the other four, insurance, formats: life, and then death, sickness, and so on.
Yes.
Now, for life insurance, you've only talked about the term, whole life, and endowment. Does this mean like life insurance does not cater for death and other uncertainties like sickness, or it's only during your lifetime that you can actually benefit from life insurance?
Very interesting thing. Just to be very clear, all the things I talked about are all under life insurance. What I mentioned about the four, I said all the product insurance companies will have, a life insurance company will have, will fall under the four categories.
Okay.
Meaning, you die, they pay. You fall sick, they pay. You retire, they pay. And your children go to college, they pay. So under those four categories, you will find that pretty much all the products fit in there. All right? Now, I went ahead to explain that the different products that fall under the four can either be term, can either be whole life, or and also can be endowment plans.
Yes.
Yes.
Now let's look at those three categories: the term, whole life, and endowment. But even before that, we wanted to go back to the relevance of life insurance as a whole. Why do you think, first of all, is still low, standing at 1%?
Yes.
And why should we?
Okay. You see, Anthony, the thing is, there are very many reasons that the penetration will be low. And again, different players. I know very many life insurance agents are out there in the market who do what we do as well. And I hope they are proud that they are out there every single day to save families. Okay. And I think first and foremost, the first thing is life insurance agents. These are people. It's a profession that not very many people have really given attention to. Why? Because no one ever starts out thinking they're going to be a life insurance agent. It is something that people go to as a way to survive. Yet, in other markets, life insurance agents are very critical people because they help families, they help protect families. Now, from an initial stage, these life insurance agents, and I believe, the interesting thing is, at least each and every one has met more than 3 life insurance agents. I don't know whether you've met any life insurance agent.
Yes, I have.
Absolutely, because someone has probably asked you that.
Do you have an insurance plan?
Yes. Now, the gap would be that maybe they do not explain it on its benefits. Because as people are quick to say, what's the return? Not that the return is bad, but the major reason for you to take out a life insurance plan is actually protection. Then the return also is important. But also, not a lot of information has been out there. Yes, the regulator has done a lot and we give them lots of credit. I mean, in a marketplace like this, they've really done their best. But also as individuals, we ought to have a second thought, because when a life insurance agent calls someone could tell, no things of insurance, I do not understand, because maybe previously there are experiences that were faced. I may be wrong, but I think the biggest gap that is there is the ability for people to understand that life insurance, what life insurance does.
Yes.
And even those that have understood what life insurance does have limited it to only education. That's why you see most people that you will, and I think also your viewers, people have what they call education plans from all the different life insurance companies. Not to say that they are bad, but they're structured wrongly. Because someone has an education plan for 5 years, okay? But it's probably not aligned to when the child is going to go to school. Because when you're talking about life insurance, it needs, when you're doing savings, there's what you save for the short term and what you save on the long term. So if you're designing an education plan, is it sufficient? First and foremost, do you save what you want, or you find out exactly how much will be required and then work backwards? in this market, people say, I'm going to have an education plan and I'm paying 100,000. Not to say that it is bad, but the biggest question should be, is it sufficient? Is it something, is it enough to take care of what I plan to take care of? I think that is what is very, very important. But before the education plan, there's something that no one ever talks about. Because see, an education is had by someone who has survived. First survival, then the education. So most people have education plans, first of all, which they structure for a very short time. 5 years, people go for the shortest period of time. But the people who take that short time, they have what we call a reinsurance risk. And how does that reinsurance risk happen? You see, now, Anthony, you don't know how healthy you'll be 5 years from now. Okay? But as a human person, our bodies deteriorate. We will not be as healthy as we are right now. Now, knowing that, if you take out a term for 5 years, if that policy is done, the next thing is going to happen is, if the insurer is going to take out another plan, you have to be subjected to a medical, if the threshold is above. You will have to be subjected to a medical, a medical. But the thing is, if you have an opportunity to take out a longer period of time, that means you've passed on the entire risk, because risk has three things. The first one, you can either avoid it, you can ignore it, or you can transfer it. So if you take out life insurance, you're saying that, listen, these three things are a big worry to me. I can get permanently disabled, I can be critically ill, and I can die. Now, those three things, I'm going to pass on this risk to someone, an insurance company, that should be in position to accomplish what I desire to accomplish, should I not have the time to accomplish it. Are we together?
Yes.
So literally, that's how you structure it. But then, even the ones that are saying, listen, I'm okay to take out an insurance plan, or a life insurance plan, or maybe an education plan for my children, they do short term, which is 5 years. Then they leave that exposure, because of a 5-year plan, you cannot amend it. Yet if you took out a 10-year plan, or 15 or 20-year plan, depending on your choice, you have an opportunity to increase the premium, provided the last 5 years are not touched. So if you're taking 15 years, you can increase your premium all these first 10 years. As you increase the premium, also the sum assured increases. Why does it increase? Because as people, our expenses also change. Because today, right now, Anthony, you probably could be spending $1 million shillings on a monthly basis. On that 1 million shillings, there are your needs, but also there are people who depend on that 1 million shillings. So if you decide to take out an insurance plan, life insurance plan, you will hedge it based on that 1 million shillings and say, okay, 1 million shillings times 12 months, which is probably 12 million. You multiply it by 5. Why? You're saying that these people who depend on this money, all right, if anything happens to me, what's something, permanent disability, critical illness, or death, the people who have been benefiting off my salary will continue earning for at least for the next 5 years, or will have a lump sum for at least the next 5 years as they figure out what to do next. That's why we multiply it by 5. Of course, as a family, as you grow, as God blesses you and you get more wealth, I've seen families who actually plan for 10, even 15.
Yes.
Now, as a country, yes, our penetration is still very low, but we also didn't have that big opportunity. Today, we don't have any excuse. Today, we have very big players in the market. I will not go ahead to mention them, because at Aton Capital, they are insurance companies we prefer to structure plans with. But for purposes of this discussion, I will not mention them. But there are many players in this market, and global players. And some of the players are among the top 5 leading insurers in the world. You see, we don't have any excuse, because the previous generation, you could maybe at some extent say, you know, we didn't have those really very sounding global insurers. Today we have them here. That would be the first, I think, one of the things that, or those top players were not in the market, information out there. Anthony, you see our videos that we do those videos to push them out, to sensitize people. Because like I told you, people have limited life insurance to only education plans. But guess what? You can use life insurance for succession planning.
Yes.
You can, that's in a business. You can use life insurance in estate planning. You can use it, under estate planning, you can use it to settle tax obligations. Or if someone along the journey of life takes out some level of liability and they want to shield their family, should they not be in position to be around, they can take out a cover that will shield their family from any liability, and they do liability cancellation plan. All right?
Yes.
You can use life insurance. I've mentioned about
education,
succession
estate
planning, estate planning. There are many things you can use.
Can you
life
use it for
insurance
loan, protect your family against
Absolutely. Mortgage protection.
yes?
Okay. You can use it. Only that in our space here, the banks have gone ahead to, in most facilities they offer, they've already incorporated a cost for mortgage protection so that it safeguards them in case and they don't make, it passes on the risk to the insurance company. The money is actually safe. Should this person walk out?
Yes.
So there are many things you can do. But life insurance has been reduced to only education. And I fully understand because you see education in Uganda, first of all, is very expensive. And on top of that is something that's really passionate about. That's why you see when you see many insurance companies, they will plan their product to have a bit of education, whatever, and all these other things, which is a good thing because maybe it's a way to sensitize our people. But we need to
them to these
absolutely. But we need to move it a bit further, a bit notch higher. And I encourage all financial advisors that as and when you have an opportunity, please go out there and share as much information as you can. The reason why life insurance, there are two reasons. You see, Anthony, most investments you require a lump sum. If today you said I want to go and make an investment in property, you need a lump sum, correct?
Yes.
If you said, let me go and start out in equities, even equities, they will tell you, okay, you're going to buy shares, but there's a minimum threshold of which you're starting with. All other asset classes, be it a fixed deposit, be it a number of other...
Treasury bonds at 100,000, treasury bills.
Yes, there is usually a threshold. Life insurance today is one of those assets that you pay as you go. Now listen, Anthony, if you decide, listen, in the next 20 years, I'm going to take out a plan for the next 20 years, and I want to start paying on a monthly basis on premium X. But with a plan that I will continue increasing my premium, it takes you, 7 days, 5-7 days, and you have created an asset. It is the easiest asset we can create as young people, and yet it is the most valuable asset. Guess what? Because when you walk out, walks in. It's the only asset from my experience, Anthony, that the day you walk out, walks in with money. And this perception where people think life insurance is only paid out when you die. No. When you take out a period, let's say of 10, they pay out either when you're exposed to the risk you've taken out cover for. For example, when I do income protection plans for my clients, it's very vital for me to cover 3 risks, which in this country I think are very critical because you can get permanently disabled. Whether you drive or not in this country, you have that risk. You don't need any history in your family today to be diagnosed with a critical illness. Do you agree?
Yes. Okay.
And because of our lifestyle, because of the food we eat and very many other things, we don't exercise much. Most of the time we are seated. So very many things, and our lifestyle causes us to have that risk. And the last one, which is death, which is inevitable for everyone. It is only a matter of when. So when I'm doing income protection plans for my clients, I make sure those 3 risks are taken care of. The way I structure it, I make sure that in all the 3 incidents, there's a payout. If any of the risk happens, there is a payout. Of course, the element of death, when it happens, it's the optimum. The 100% is paid. But depending on the product you design or you structure for your client, some policies will pay out either when the risk has happened or at maturity. So I can take out for a period of 10 years, all right, if I qualify for the age and my medical bill qualifies me to get that plan. If I take out for 10 years, if no risk happens within the 10 years, I still get my money.
That is exactly what many people out there actually don't understand. I think. So you can actually walk in as the 10 years have passed, I've been giving you my premium, and I think I want to take out that money. They can freely give you that money.
Absolutely. And even depending on the plan you take out, there's some plans that are highly liquid. For example, when you're designing income protection plans, an income protection plan what I do, and I want to share what I share is what I do here. I mean, there are very many financial advisors out there, and please look out for some as well, so they can give you a different context as opposed to only me.
Yes.
When you're designing an income protection plan, unlike an education plan, okay, an income protection plan, you want to design something that is highly liquid. So the plan that I have, that I structure for my clients, an income protection plan, I make sure it is liquid after 3 years. Even if I've taken out 15 years, I should be in position to at least access 80% of my money after 3 years. Actually, it's not your money. You should be in position to access 80% of the part of the premium you're paying.
Yes.
In most plans, you find that it is very highly liquid. If you actually stop your policy midway, because that's the only way insurance company will earn. Because these 4 things will surely happen. You will surely die, you surely fall sick, your children will surely go to college, and you will surely die. So when you actually cancel your policy, it's the only time the insurance company will make money. But if you wait out the time, depending on what product you've designed or you've structured as advised by a financial advisor, chances are high that, and by the way, chances are high that insurance will lose money.
Do they give you exactly the premium you've been saving?
You see, the way, I'll give a clear example on how insurance works. For example, as Tony, I'll say, listen, I want a sum assured for maybe 150 million should any of the 3 things happen to me. Which 3 things? Permanent disability, critical illness, or death. That 150 million shillings will help me sustain my family. Okay, and the insurance company will ask, are you healthy? Because people think that insurance is only taken out by money first. No, it's first your health bill. How is your health bill? Because actually there are some incidents where the insurance stands down. Life insurance proposals from people. So once you qualify, your health bill qualifies you, all right? And then you say, fine. The insurance company says, okay, we are willing to do that, provided the client pays this premium. So literally, you're paying a premium. For example, let's say you've taken out a term of, let's say, 15 years, and you want a sum assured of, and you want a sum assured for 150 million. Okay. So literally, what happens is the insurance company will tell you, for as long as you pay a premium, let's say, of 200,000 for a period of 15 years, if anything happens to you, we will pay the 150 million. So the money you are paying is a premium, because insurance is a service. And insurance is accepted to take a risk that as long as you get your 200,000, if the risk of permanent disability, critical illness, or death happens to you, we shall pay out the sum assured. So your premium that you're paying is actually, you're paying for the 150 million. Now, the incidents where actually no risk happens, fantastic, and that's what every financial advisor ever thinks about, that no risk happens. What happens at the end? At the end, because it is a contract, the life insurance company will still pay you your sum assured, the 150 million.
Wow.
Okay? And give you the bonuses accrued.
Wow.
And let me share something.
No.
On life insurance, the bonus is given on the sum assured. So many times people are saying, I will say, no, the interest is, no, in insurance there's no interest, it's actually bonus.
Bonus, yes.
Yes, because it's not a bank, we need to
Yes.
separate.
Yeah.
Now, the bonus actually is cumulative and is earned on the sum assured. So much as I'm paying my 200,000, at the end of the year, all right, my bonus is issued, depending on the company's performance, right, is issued on the sum assured. So at the end of the tenure, I'll get the sum assured plus the accrued bonuses. And Anthony, by the way, when you look at the returns and you look at it, it's not something I usually like to look at because it takes away the whole concept while you're taking out insurance.
Yes.
But when you look at actually the return on investment, it's not bad. I can tell you it's way performing that very many other assets or very few businesses perform with that kind of return, which is guaranteed. By the way, we need to tell you that it's guaranteed. The sum assured is guaranteed.
And the bonus is
the bonus is not is what varies. Okay.
Because, yes,
and it is determinant on the performance.
Yes.
You understand? It's determinant on the performance of the insurer that you have the plan with.
Okay. Wow. So we are still talking to Mr. I've even forgotten. We had to go for a break, but we are still talking life insurance. We are still, understanding why it's important for you to have life insurance, because as savers and investors, as we invest in assets, in bonds and all these other things, we cannot enjoy those when we are not alive. And now this is an opportunity for us to learn more on these policies that are actually help us to save for our lives, because it's called life insurance. Don't go away. We'll be right back with Mr. Tony Mugisha for more on life insurance.